Okay then, so good morning. Good to be on the mic for the briefing. It's been a while. So let's just start with what's happening right now. We've just been through really the perhaps a more interesting information flow of the day. So we're just getting the preliminary PMI numbers for the month of September. This is for Germany. We've just had the German numbers delivered a couple of minutes ago. We've had France already deliver their numbers. We had some Japanese numbers overnight, and certainly on the manufacturing side, it's good news actually. So Japan's manufacturing print last night went above 50. If I just actually, I'll come back to the charts in a sec. Just check out the data calendar here. So we had Japan overnight, the number coming in above 50 when we had expected 49.3. But really it's the French and indeed the German manufacturing print that we've just had that that's impressed. So just on the German number, we had expected 53 on the manufacturing side, but we got 54.3. Check out the chart here. This is almost matching that print we had back in June, and as you can see, this is right up there on the kind of top end of the spectrum that we've seen for German manufacturing data for at least 12 months. If I go back a little further onto a 5-year time frame for this chart, then you know, we're edging back towards this 55 level, and we've only been above 55 for German manufacturing very, very briefly at the very beginning of 2014. That's the only time since 2011. So it's actually pretty encouraging. And when you add in the French figure, so France delivered their PMI number earlier, and that also quite considerably beat expectations. So we had it did beat expectations, but ultimately the number's still below 50. You know, France has been certainly an underperformer with regards to PMI data for, well, really the last few years actually, but we had expected 48.4, but it came in at 49.5, and the thing about that is it, you know, really just takes France out of this depressing 5-month period here between April through till August, where we were kind of locked down below 48.5. So nice little pop higher. This is the best reading we've had since Q1, but still below 50. But on the services side, this is where the French data has really outperformed. The services sector data for France was 54.1. So we had expected 52. 54.1 puts it at the best reading for 5 years. So actually this is pretty encouraging from France particularly. The 1 week print has been the German services number, which actually disappointed expectations by coming in at 50.6 when we had expected 52.1. So a bit of a mixed bag on the German side. Let's just flick back to the charts, see what's going on. I mean, it's been, let's just take the DAX to start with, given we've been just had the German numbers. I mean, the thing about these markets generally is, you know, the movement we've had this week has been very strong, and it's been all about, well, really nothing to do with Europe. It's been about the monetary policy developments, and, you know, certainly with Japan and then the Fed, and that's what's launched this market to the upside. If I put this on a daily chart, you've got to understand where we are. Look at the size of that move yesterday. Big move, and this has really propelled this index right up towards the kind of double top that we have for, well, this is just the December contract, but the double top up around 10,783, the mid-August, and then the kind of mid-September double top. So we're right up there. What's happening right now, of course, if I go to like a 15-minute chart, well, this morning we've just been drifting marginally, well, sideways, and now kind of marginally lower. It's really a consolidation of that huge move. If you go back to Wednesday, just after the European close on Wednesday, the DAX dipped below 10,400, and, you know, yesterday we almost hit 10,700. That's a 300-point reversal in about 24 hours. That's impressive stuff. That's a 3% move. So naturally a bit of exhaustion and consolidation. You've got this support level that kind of capped or defined that consolidation yesterday afternoon and indeed last night into the close, and we're just kind of grinding and drifting through that now. So this German data has been mixed because that services element was weak. If you look at Euro stocks, it's even more pronounced in terms of the drift to the downside, as we've definitely sorry, let me just change it to a shorter time frame. You know, we've definitely the Euro stocks have definitely been under more pressure than the DAX here, and we're breaking down below the pivot level. Even though we've had good data, and that French data particularly, and you might even say, I mean, it does look a little bit like we're getting the scenario where good news is bad news for Europe. You know, I'll talk about the ECB in a minute, but obviously people want to see the ECB extend their QE program. There's obviously complications with that. Logistically, are there going to be enough assets for them to purchase to allow them to extend it? And legally, is it going to be allowed? But the point being, people expect the ECB to extend their QE program, unless, of course, the unthinkable happens, and that's actually the European economy starts to gather a bit of momentum. I mean, nobody's considered that as a potential scenario, but if it were to happen, well, then maybe the ECB don't need to extend. So maybe you're getting a bit of downside, good news on data, and especially when it comes from France. I mean, of all countries, good data out of France is that's like something that's not. That's like a pro-English French person, is Will's comment. Anyway, something that's incredibly rare. But I think, you know, really, whilst what I've just said, maybe there's something in it, I think it's probably just overthinking it a little bit. We're just coming down here. We're breaking lower, simply, even though we've had good data, simply because of this massive launch to the upside we had over the 24 hours into mid-afternoon yesterday. So it's just a bit of profit taking. You perhaps want to get some Fibonacci's on these kind of moves, with the Euro stocks here heading for the 38.2 fib now that we've broken below the pivot. Okay, so downside pressure, giving back some of those gains from yesterday. Perhaps there's an element of good news is bad news with regards to potential for further QE from the ECB. Just check in on the euro and how is that faring off the back of this data. So here's the 15-minute chart for the euro, and as stocks rallied hard, actually let me go to a 1-hour chart, because obviously the move, or the main motivation behind the move to the upside in European stocks was dollar weakness off the Fed. So this is why the euro dollar itself moved higher, which in itself is not normal. Normally you'd find that European equities are inversely correlated to the euro, if anything. Obviously that wasn't the case, but the euro dropped off quite sharply into the close yesterday, and we've had pivot level resistance this morning with regards to the reaction to the euro's value off the data we've been getting. Well, it's been positive, and that's what's taken this market up to the pivot level, and we're just kind of sandwiched between the pivot level and that overnight high we had at 112.50 area. So you know, I think the moves we've seen this morning are more about pullbacks from yesterday's you know, big action more than anything else. So let's look at just looking at the early morning read this morning, and what they were showing was, well, it was actually quite interesting. They were talking about, well, the thing is, it's well, they were talking about two things that were interesting. Firstly, in the 24 hours since the FOMC, where obviously the Fed did not hike rates, as you all know, basically everything has gone up. That's and what the Deutsche Bank research guys did was try and find any market that went down, and it's quite shocking to the number. Just think about how many markets there are.
Energy complex at the moment.
Yeah, you're getting a bit of oil break to a new low here. I'll talk about oil in a second, but this is a list of the markets, and these are the entire global markets. This is a list of the markets that have gone down. Obviously, the dollar went down. Outside of the dollar, you've got Egyptian, Slovakian, and Macedonian equities. They've dropped. You've got corn and natural gas. They're the only two commodities that have gone down. And then in the FX space, other than the dollar, it's the Taiwanese dollar, the Kiwi dollar. They're the only two currencies that have weakened. And in the bond market space, only Chilean 2-year government bonds. They're the only ones that have gone down.
Wow.
That's the only. That's 1, 2, 3, 4, 5, 6, 7. That's 8 markets. Everything else has gone up. That's the power of monetary policy. It's still in the system. How long this power lasts for? Because let's check the S&P. I'm just seeing we have got a bit of downside here. This euro dollar is now broken to the downside. We are getting some movement here on oil as well, by the way. So oil's just ticked to a new low. We had been finding support at 45.76, but that's just been edged through. And yeah, you're getting downside on cable also, and that's a kind of break below S1. Any classic shorts on that trade might have been successful if you hung in there with a decent sized stop. Now, other than this movement, then just with regards to the other thing that Deutsche were talking about this morning, because it's the anniversary. Well, it's not the anniversary. It's the quarterversary of the Brexit vote. I'm going to switch my screenshot. Check out the chart here. What they're looking at is how have asset prices changed since the vote. So it's 3 months today we voted, and this is a look at the returns. This is in local currency terms, and you can see the FTSE right up here is the second best performing. It's the third best performing equity market. The Hang Seng's the best. The Bovespa, that's Brazilian market, is the second best. Third best is MSCI emerging markets. The FTSE's fourth. I apologise, but you've got Russia in here as well, certainly, and then the Shanghai Comp. You've definitely got an emerging market theme to outperformance in the equity space. A lot of that is because of underperformance in emerging market equities earlier in the year, but the FTSE obviously benefiting from the weak value of sterling, as is gilts. So gilts a big outperformer, and actually since the vote the FTSE's up 10% and UK gilts are up 9%. Who would have thought? Gold is also a good performer. That's a lot to do with the fact we had that burst higher on gold. If I just switch back to my charts screenshot, then checking out the gold daily chart, then you'll see that every market went up off the Fed, but perhaps gold went up the most, with a big climb to the upside. But all that's done, by the way, is taken us to the kind of top side of what looks to be a bit of a descending wedge, which we're going to need to see break. Let me just draw a trend line here along the top, something like this, and we hit resistance there yesterday for gold. So just be aware of this downward trend line of the last few months. You're going to see, if you get a break of that, well, then maybe that will be the catalyst that some, including somebody sitting quite close to me, Will DeLucy, is expecting to be the catalyst for the launch and an attack of the high of the year that was set back in the summer off the Brexit vote, of course, up at 1384. So the low being the 1st of September low, 1305. That's the kind of bottom of the post-Brexit consolidation pattern. So keep your eye on gold in this trend line in the coming days. But yeah, in terms of, back to that chart, looking at asset performance, you've obviously got some underperformance on the right-hand side. Obviously sterling up there, so cable, the second worst performing market since Brexit for obvious reasons. But look, you've got corn and wheat have been underperformance. And then oil, of course. So let's talk about crude, because that was a market that's on the move. Let's switch back to my charts and we'll just check out the crude oil situation, because crude has had a good week and it's doing its best to give some of those gains back right now. So we're under a bit of pressure here. Not too much news flow, although there was some news last night. We had a bit of volatility. If you were at your desks around about 6:30, or well, around about 6 o'clock-ish actually. Firstly, we had, this is all chat ahead of the OPEC meeting, which is in Vienna next week. All right, so in terms of focuses on the path ahead, you know, we're past all this FOMC and Bank of Japan shenanigans. So what have we got to look for now as stuff to monitor and be worried about? Well, this oil meeting in Vienna next week is an interesting one. We're going to get a lot of headline focus on this, and so this is going to be something to have to deal with pretty much every day. So yesterday we had the Algerian oil minister basically saying that sorry, not the Algerian oil minister, apologies. So there's just reports state there's been no breakthrough reached at the OPEC meeting in Vienna ahead of next week's Algiers meeting. Then the Iraqi oil minister came out and he kind of countered that by saying that he hopes the upcoming OPEC meeting in Algeria can set a production ceiling in order to prop up oil prices. So these are the kind of headlines you're going to see now pretty much every day, I would say, until that meeting. But what else have we got in the pipeline? Well, next week is the final week of the quarter. So that means as we hit October, we're going to get quarterly earnings season from the US. We're going to get, obviously, the round of Tier 1 data from the US, including non-farm payrolls. But I would say for now, that's less important because we've just had a Fed meeting. And the likelihood is the November meeting's pretty much redundant because it's just 6 days before the US election. And so really, we've now got a 3-month gap before we have any genuine Fed risk. So kind of the Fed are off the table for a bit. And so it will definitely be the election. And on Monday next week, we get the first televised debate between Clinton and Trump. And it's quite amazing, but they're expecting the number of people to watch this debate. They're expecting it to break the 100 million mark. They reckon more than 100 million US citizens are going to tune in to watch this debate, which makes it obviously a hugely important event that could really genuinely have a powerful effect on shaping the outcome of the election. So election fever is going to ratchet to new highs next Monday, and then that'll be the case for the run-in to the election. So that's going to be the big theme. Other stuff that's happening, well, we've got the Renzi referendum in Italy, but that's not until the 27th of November. So really it's going to be all about US elections. It's going to be about US earnings season. Then we'll switch and turn our attention to Renzi, and we'll start thinking about the December Fed hike. Also, the ECB need to be thought about. And we've got Weidmann talking today. Let me just flick back to the calendar. Where is it? Here, if I scroll down, just to kind of complete the set here. At 9, we've got the Eurozone manufacturing PMI. This is going to be expected at 51.5. Bear in mind, we've already had the two biggest economies in the Eurozone report. Both their manufacturing numbers were better than expected. So naturally, we are to assume that the EU one here will also beat expectations. So this 9 AM data actually isn't that important, I would say, because we've really already got an insight into that with the information we've already had this morning. On the services side, well, the French number was really good and the German number was bad, so perhaps the European number is going to be more neutral, perhaps around expectation levels, which is 52.8. So that will round up the data for the morning. We're then into the afternoon with really only one print of any note, and that's the manufacturing PMI number from the US. The thing about that is, and that will be interesting, I think, and that is because don't forget what happened last month. If I quickly show you, well, there was a bit of a contradiction on the PMI reading from the US last month. The manufacturing PMI reading came in at 52, and it didn't seem to be all that interesting. But what was interesting was the more official government ISM manufacturing number. We only get this after the month has finished. So to get the September ISM manufacturing print, we've got to wait until the first day of November. So, but this manufacturing number now, the preliminary number for September, might give us an insight, because what happened for August here, we had a shocking number on manufacturing, big drop, and importantly back below 50. So this afternoon's number might give us an insight as to whether this dip in August was just a temporary blip, or whether it's something we've got to be more worried about. So that'll be the main data out of the US this afternoon. But check out the speakers. Actually, I'm just looking on the speakers calendar. Weidmann's not there. I think he should be. Apparently Weidmann's speaking. We haven't really heard much from him for a while. But it'll be interesting to hear what he's got to say, if he's going to talk about monetary policy, that is. But just the final thing to leave you on with regards to a risk moving forwards into year end, and that risk is ECB QE implementation risk. Here's an article that I was reading actually yesterday, but you guys know the story here, in that we've talked about the fact that ultimately, you know, it's fine, the ECB might want to extend QE, but can they extend it? Are there enough assets to buy for them to actually implement an extended QE program? And as it stands, the answer to that is no. Very roughly, they've got about 6 months left of German bonds that they've got to buy 20 billion German bonds a month as part of their rules. Their capital key rule means that ultimately, of the 80 billion that they're spending each month, that 80 billion has to be spread proportionally across all 19 Eurozone countries. When I say proportionally, it's based on the size of your economy. So Germany's the biggest economy in Europe. It's 29% of the Eurozone. So 29% of the 80 billion euros has to be spent on German assets. So that's the deal. That's why they've got to buy 20 billion euros of German bonds a month. The only problem is that the other rule is they're not allowed to buy more than 33% of any one country's bonds. So this means in 6 months, buying 20 billion a month, they're going to hit that 33% barrier. So they only got 6 months left. So when they say they want to extend it to September next year, well, actually they can't at this point without changing the rule. The only issue is there's massive political pushback on changing these rules. And when I say massive political pushback, there's two people you need to be aware of. There's this guy called Peter Gauweiler, which I've probably massacred in terms of the pronunciation. Peter Gauweiler is one guy, and then the other guy is somebody called Hans Olaf Henkel. Remember these names. Why? These are two German guys that are actually trying to sue the ECB because they think that the ECB are right now breaking the law. And they think that the QE program is illegal. And what they've said, and Hans Olaf particularly has said, is that if they change the capital key rule, which means they can actually start buying bonds, and you know, they don't have to spread it proportionally based on the size of the economy. Basically what they'll do is they'll just have to then start wading in and buying a hell of a lot of Italian bonds rather than anything else. This will basically be, in the eyes of these two guys, this will be directly financing the Italian government, and this will be huge ammunition for them in their court case. So they're actually, this Hans Olaf Henkel guy is rubbing his hands and saying, go on ECB, please, please change the rule here. Please scrap your capital key rule, because then I'm going to beat you in court. This will be perfect for my case. And so there's a big legal issue here. So I think one of the big risks into year end, sure, the election, absolutely. Definitely Renzi's referendum vote on the 27th, and then on 27th of November and on the 4th of December, for sure. And then definitely item number 3 of my top 3 risks into year end is ECB QE implementation risk beyond March 2017. So there we are. Right, I'm going to leave you to it. In terms of what's going on market-wise, we've still got, you keep your eye on oil, which has just made that move. We haven't really broken out very far to the downside, but it's just we're below that overnight low, and so perhaps looking a little negative. With regards to the euro, it's kind of heading back down towards the low print we had overnight, 112.3250. That's the bottom of the day's range. So perhaps you've got a bit of dollar strength in here, although cable has just bounced a little bit. But generally equities are, again, they've just added a touch of upside, but equities have been on the back foot this morning despite the good data, but now we've seen a little bounce. Eurostock's back above the pivot, for example, so perhaps things are just going to settle down a little bit here. Right, I'm going to get off the mic because we've got the European PMI data hitting the wires in 30 seconds. Enjoy the day. Thanks.